The global gas market is becoming more integrated as flexible LNG cargoes respond to price signals in regional markets. LNG trade is becoming increasingly dynamic as contract lengths become shorter, resale and destination limits are lifted, and trading houses take a larger share of the market. In 2018, 32% of cargoes traded on a short-term basis or spot basis. This has led to increasing degree of price conversions across Europe, Asia, and the US. To understand the dynamics of integration, let's review each market.
The US gas market is characterized by a low-cost resource base with a significant volume of associated gas, which acts to detach gas production from gas market fundamentals. Dry gas production has increased 37% since 2012, which has overwhelmed the domestic market and led to a multi-year period of low price volatility and depressed pricing. So these low prices have resulted in demand creation. Gas-fired power generation surpassed coal to become the leading power generation source in 2016, with record power burn for gas recorded in July 2019. LNG terminals were also commissioned to clear the market via export. 6 liquefaction facilities were part of the first wave of US terminals, and by end 2020, feed gas for export will represent 9% of total US gas demand. The contractual structure of US terminals, including both destination flexibility and cancellation clauses, will increasingly expose the US to global gas market dynamics. Gas delivered from US terminals is among the highest on the cost curve, owing to relatively high liquefaction costs and distance from destination markets. Given the flexibility written into these contracts, US gas is likely to represent the marginal molecule in the global gas market, with loose LNG market conditions exerting downwards pressure on US hub prices and vice versa. Asia is LNG's legacy market. Limited domestic gas resource in traditional importers such as Japan and South Korea has resulted in LNG being the main source of gas in these markets. Northeast Asian gas demand represented 60% of the global total in 2018. As the main source of gas in these markets, structural LNG demand growth has always required impetus from Asia. Japan, in the aftermath of the Fukushima disaster between 2010 and 12, where LNG demand in the region increased by 30.7%, and China between 2016 and 2018, where LNG demand increased 26% over the period. The region has been typified as a relatively inflexible market, with importers historically preferring to secure supplies via long-term contract. Spot demand for flexible LNG cargoes, which is a key driver of JKM price formation, therefore reflects LNG demand beyond the current contracted level. With limited additional gas sources, Asian buyers are usually always willing to pay more for LNG in times of tight supply. We see this through a higher JKM premium to European hubs, which encourages flexible cargoes into the region. China's explosion onto the global gas market over 2016 and 2017 reflected an ambitious government policy on coal to gas switching, with the country's LNG demand increasing by 98% between 2015 and 2017. However, the Chinese gas market is maturing. Storage facilities are being built out, we have additional pipeline supplies from Russia, and growing domestic production, which represents structural trends, which along with cyclical trade war headwinds, may limit Chinese gas consumption growth going forwards. Increasingly, the market is looking to emerging Asian buyers such as Bangladesh and Pakistan to drive a new phase of structural LNG demand growth. However, due to entrenched subsidy systems, there's significant uncertainty regarding the price that these importers can pay.
The European gas market is typified by optionality of supply, with numerous LNG import terminals, along with major pipeline suppliers Russia and Norway on its doorstep. Europe has a high storage capacity of 100 BCM, a dynamic power sector which can exhibit switching from coal to gas, liberalized market hubs, and the ability to flex contracted gas supplies in long-term contracts. The optionality of supply, along with considerable potential to absorb gas, make Europe the market of last resort. While in the near term, gas will benefit due to the phase-out of coal, on a very long-term basis, European demand for natural gas is under threat from the EU's efforts to make the bloc's economy carbon neutral by 2050.
So, disparate markets are increasingly being linked by LNG. Let's use the current market as a guide to these processes. So firstly, during 2019, Asian LNG consumption growth, which as we've discussed has been the structural driver of LNG demand growth in the past few years, slowed. So between Jan and July 2019, consumption growth in the top 4 Asian buyers contracted by 1%, compared to 11% growth over the same period in 2018. So this occurred over a wave of new supply coming online in 2018, where it increased by 14% in the fourth quarter. So the Northeast Asian requirement for spot cargoes diminished. To deter cargoes away, the JKM narrowed to the TTF, until the netback of flexible LNG supplies was higher for delivery to the European market. So during periods of acute oversupply, TTF actually traded at a premium to JKM. Due to the properties of the European market, Europe has been able to act as a swing buyer and absorb some of this growth. So the 9.2 BCM year-on-year growth in US LNG exports has overwhelmingly been taken up by the European market, to the order of 86%. The flood of US LNG into Europe reflects the variable cost of shipping LNG to each market. Netbacks have generally favoured Europe for Atlantic Basin cargoes through 2019. Europe's swing buyer response has been fully evident this year. So storage is filled and now has reached 89% compared to a 5-year average of 74% for this time of year, while gas burners increased 5% year on year. European hub prices have progressively moved lower as the market looks increasingly oversupplied. Other suppliers, such as Russia, have not pulled their supplies back, instead seeking to maintain market share. With limited requirement for spot cargoes, the JKM has followed the TTF lower. As a marginal exporter, the short-run marginal cost of a US cargo hypothetically represents a price floor for the TTF. US prices are required to move lower to keep export arbs open. Essentially, a slowdown in Asian gas demand through 2019 has been unable to absorb new supplies, which has resulted in depressed gas prices globally. Price convergence and gas market integration is truly here.
But it won't be like this forever. The LNG market is inherently cyclic, and we have a good visibility on new projects. Limited new supply capacity is due to come online between 2021 and 2024, which could lead to the market tightening from around 2021 if the current low prices encourage structural demand growth. However, the countries that are forecast to provide this growth generally have a low tolerance to pay high prices for gas, given an entrenched subsidy regime. It is therefore uncertain which price the market will balance that. If the market does tighten, logic would hold that Europe's status as the gas market's swing buyer would see the region turn down LNG, with emerging buyers willing to pay higher prices. However, decreasing domestic production may result in the continent's balancing status weakening if LNG becomes increasingly integrated into baseload supply within Europe, especially in the context of declining domestic production. This could lead to heightened volatility in times of peak consumption, especially given decline of flex.